So Jason, coming all the way out from the U.S. to Königstein to meet some of your U.S. folks that I know you know well. But thank you for being here. It's a true pleasure, as I mentioned, having also a U.S. investor perspective. Before we talk about your views on the market, how you see the future, let's first learn a little bit more about SWIB. Tell us about your role at SWIB and background on the organization. I'm sure everyone is curious in terms of AUM and how you allocate it, and kind of broken down where you've invested by region, by sector, risk profile. Maybe to just get a little bit of an understanding who SWIB is, especially the real estate portfolio.
Yeah, of course. And good morning, everybody. Happy to be here with you in person. Looked like folks were having a good time last night. Certainly enjoyed the speakers yesterday. Hope you all did as well. So State of Wisconsin Investment Board, or SWIB as we're known, we manage right now about $160 billion in assets overall. $130 billion of that is what's called the core trust fund, and that's the part that has real estate within it. SWIB was founded in 1951. We manage the investments of the Wisconsin retirement system, so we're effectively an investment manager. There's another state agency that actually distributes the benefits. And so within the core trust fund, there's obviously a lot of time and attention spent on asset allocation. Right now, the target to real estate is 8%. Unfortunately, we're still a little over that. So we're at 9.2%. Our allocation is $12 billion. If you drill in, why does SWIB have real estate? It's the same reason as most other institutional investors. It's a source of diversification. It's somewhat of a hedge against inflation, right? It's not perfect, but it does sometimes work and do what you want it to do. I would say if you look at what we're trying to do overall, one of the best things about SWIB is that we're fully funded. So at the real estate level, we're not trying to shoot the lights out. We'll do that with a small percentage of our portfolio, but on the blend, I would call it core plus. So if you think about your traditional real estate risk classifications, about 70% core plus, 30% value and opportunistic. A lot of times that distinction gets a little bit blurry. We are primarily domestic, and I think we'll get into this maybe a little bit, but we're 95% US, and I'll explain a little bit more about the rationale for that as we go forward. But one of the main reasons why we structure the portfolio the way we do is, and sometimes it's a relative game, and I'm sure a lot of the other investment managers in this room sort of have this as well. So our benchmark is an acre-reef odyssey. And so when I think about what my team and I are trying to do, we get looked upon much more favorably if we beat Odyssey, right? Beat it by a certain margin. And so we think a lot about that as we structure the portfolio. If you drill down, we're mostly sheds and beds right now, like a lot of folks. So about 30% industrial, 30% residential, but including some of those extended residential sectors that you heard about yesterday. So I would include student housing in that mix. We do a little bit of single family rentals as well. We've always been big in the alternatives. So right now we have about 20% what I call sort of other stuff, extended alternative.